the conference with a few words, and they will be a few words, because I am conscious that we are running just a little bit late, but I think this afternoon has been so far certainly interesting. That's an Englishism, interesting. I now have great pleasure in introducing James Doty, the chairman of the PCAOB in the United States. We are very fortunate to have Chairman Doty to come to Brussels and address our conference. It is only January that he took up his role. We did write to him quite early on in his tenure as chairman of the PCAOB, and he kindly accepted our invitation. So the reason Chairman Doty is in Brussels is to address you at the FEE conference. And personally, as president of FEE, I'm very, very grateful that James Doty has put time in his schedule to come and address us. You will see from the synopsis in the papers about his career. He's a lawyer amongst accountants, but actually has a very, very important role in the US as chair of the PCAOB. You don't want to hear any more from me at this stage, so I will introduce James Doty.
Thank you, Philip. From the looks of the number of bags out there, I was tempted to say that Philip has authorized me to dismiss us all, but that would not be true and it would not be appropriate. I thank him for the kind words. It's a genuine honor to be with all of you today. I want to thank the Federation of European Accountants for convening a distinguished group of experts to encourage new thinking about the role of the audit profession and what it can play in strengthening financial systems, both here in Europe and abroad. I also want to thank all of you for the extraordinary welcome my colleagues and I have received here in Brussels. Although the conference is coming to a close, the opportunity to be here signifies several beginnings for me. As Philip has mentioned, I'm new in my role at the Public Company Accounting Oversight Board. This is my first trip to Europe in this role, and when I leave the conference this evening, I will head directly to Paris to meet with our counterparts, the chairman and staff of the H3C. I look forward to many more such meetings. I'm enthusiastic about what we can do through auditor oversight, both on our own and with our counterparts, to improve the quality, reliability, and transparency of financial information. Let me explain why. But I do have to say that the ideas I expressed today are my own. They should not be attributed to the PCAOB as a whole, any other members of the board, or the staff. We're experiencing extraordinary, challenging times. In the United States, we've experienced the worst economic crisis since the Great Depression. We've lost not just one, but several titans of the U.S. financial industry, an industry that we had thought secured the economic well-being of our nation. A determined people, such as we all serve, can overcome such setbacks. With the lessons we've learned, we can build financial systems that embody the great strength and character of all our nations, while serving as an example to the world of how fair societies protect their people. Two U.S. administrations have devoted enormous effort and concentration to mending our economy, and European leaders are also clearly focusing on rebuilding and restoring stability. As a great American lawyer, Rufus Choate, in an 1841 speech to the United States Senate, reminded us, "The final end of government is not to exert restraint, but to do good." I'm absolutely confident that through cooperation, we can achieve our goals, but the task will require hard work. It will require both U.S. and non-U.S. authorities to bring creativity to bear. This is not just a banking problem to be solved by finance ministers and bank supervisors. A better early warning system based on more relevant and reliable financial information about risks and about leverage, liquidity, will undoubtedly have made a difference to boards, bank supervisors, and investors. Reliable financial information is also fundamental to investor confidence in the fairness of markets. Good audits are critical to reliability. In the United States, and of course, good audits go hand in hand with good corporate governance. Good audits benefit not only investors, but audit committees, boards of directors, even management. Bad audits ultimately hurt all of these interests. In the United States, more than half of all American households and 1 in 3 adults own stocks directly or through mutual funds. The vast majority of these Americans depend on these investments to fund their retirements. This reflects the move of the U.S. companies away from a defined benefit system, a defined benefit retirement system some time ago. Now, that move has given free people freedom from economic dependence, but it amplifies the economic consequences of inaccurate financial reporting and financial fraud, which can have a devastating impact on the everyday lives of potentially millions of individuals, as we saw when the accounting scandals at Enron and WorldCom were exposed. Employers in Europe have begun to make this shift as well. As countries move away from state-funded pensions and participation by the general public in the capital markets increases, the importance of transparent financial markets and reporting and rigorous financial regulation grows. With the discussions of convergence in accounting standards waxing, it may be useful to note actual convergence in savings patterns as an emerging trend and to reflect on the critical cultural value of the audit to that trend. International cooperation thus becomes critical. In a crisis, when a nation's or a region's economic well-being is in jeopardy, there can be a tendency to retrench and pull inward. We believe this is not the right response. We must embrace cooperation and close regulatory loopholes. We must close regulatory loopholes and the opportunities for regulatory arbitrage. This depends on continued communication and goodwill between and among regulators. We must have the courage to step forward and find solutions that best protect the public. The recent financial crisis has precipitated serious questions about the relevance and value of audits, the relationship of the auditor to the audit client, the role of various participants in the audit. The PCAOB plans to commence debate on several concepts intended together to enhance the relevance and credibility of audits and to provide the public a better understanding of auditors' work through enhanced transparency. That said, these projects are founded on the principle that audit regulation should foster conduct and a culture consistent with the franchise that the securities regulatory regime accords the profession. We have and will continue to engage in broad public outreach to obtain feedback and suggestions. We need constructive insights from a wide range of voices and experiences to help us design effective solutions. First, let's talk about the audit reporting model. Last Tuesday, the PCAOB released a paper on the first of these ideas, a concept release on potential changes to the auditor's reporting model. This project is about what information investors want from audit reports in the future and how audit reports can be more useful to society. It's about how audits can provide investors more insightful assessments of management stewardship. While auditors most certainly did not cause the financial crisis, some people have legitimately questioned whether audits adequately served investors' needs in the months and years before the crisis. For decades, the audit report has identified the financial statements that were audited, described the general nature of the audit, presented the auditor's opinion as to whether, taken in their entirety, those statements present the company's financial results and position fairly in all material respects. Given the effort involved in an audit of a large company and the complexity of many financial statements, investors want deeper insight from the auditor. This concept release explores several ways that audit reports could better serve investors. The four broad alternatives offered for discussion by our concept release show that we have not remained oblivious to the ideas discussed here in Europe and their relevance to better corporate governance. To summarize, auditors' discussion and analysis could provide a narrative of the auditor's views on significant matters relating to the audit or the financial statements. A required and expanded use of emphasis paragraphs could highlight significant areas and identify where those are disclosed in the financial statements. Auditor assurance on information outside the financial statements could include an auditor expressing an opinion on management's discussion and analysis or management's earnings releases and their processes. And clarification of the language in the standard report could enhance users' understanding about what an audit is and what an audit responsibility is, such as clarifying what reasonable assurance means. All of these are ideas that raise many interesting issues. The devil will be in the details, and we expect to hear from many commenters. The alternatives described in the concept release are the result of several months of engagement with investors and others to identify concrete ways in which audit reports can be improved. This outreach was critical since, unlike other standard-setting procedures, the project required us to understand the needs that investors were expressing before we could develop means of addressing those needs. The alternatives described in the concept release also focus on enhancing the relevance of the auditor's communication to investors. They would not change the fundamental role of the auditor to perform an audit and to attest to management's assertions, as embodied in management's financial statements, nor are they intended to put the auditor in the position of creating and reporting financial information for management. Together with the other initiatives I'll describe, this project is intended to spur debate over how to infuse auditing with an immutable emphasis on public service. I think auditors could use a bit of an image now as dedicated to public service. Let's talk about auditor independence. I'm mindful that culture does not change quickly. It would be naive to think that merely changing the auditor's report would trigger cultural change. This is why I advocate a holistic approach aimed at enhancing the credibility and transparency of audits as well as their relevance. The second project I want to describe goes to the credibility of audits. An audit has value to the public to the extent that it is performed by a third party who is viewed as having no financial stake in the outcome. As auditors and audit regulators, though, we know that auditors do face real pressures to please their clients or lose the fee. The payment model is seen as an inherent challenge to independence and objectivity as the auditor is hired and fired by the company. The Sarbanes-Oxley Act's reform to shift hiring and oversight of the auditor away from management to the audit committee may in practice have proved insufficient to counteract that conflict and others facing auditors. The PCAOB has conducted annual inspections of the largest U.S. audit firms for 8 years. The PCAOB's inspectors have reviewed more than 2,800 engagements with such firms and discovered and analyzed hundreds of cases involving what they determined to be audit failures. Audit failure does not mean the financial statements taken as a whole contain material misstatements or misrepresentations. The audit failure means the auditor hasn't done that which the standards require to show that they are able to render the opinion. They don't have a reasonable basis for their opinion on the financial statements. Doesn't mean the financial statements are misleading. I also don't suggest that every audit failure detected by our inspectors resulted from a lack of skepticism or objectivity. Some reflect maybe weaknesses in technical competence, in experience, or some other cause. Undoubtedly, however, competitive pressures in the marketplace for services, leading to cross-selling, pressures on client intake, have played a causal role as well. Moreover, as our inspections are not random, but risk-based selections of engagements, we may be looking at the most error-prone situations. We take that into consideration. Firms have implemented rigorous training and other quality control initiatives to address identified problems in our inspections. The PCAOB evaluates those remediation efforts in detail. For the most part, the initiatives have been constructive. Yet, inspectors continue to find these audit failures, including both basic areas and complex ones. Because skepticism is a state of mind, objectivity, a silent success, their absence is rarely documented and can be particularly difficult to detect. But too often, the audit failures identified by inspectors do not appear to be explainable by any lack of knowledge on the auditor's part about what audit steps are required in the circumstances. Inspections by other audit regulators have also given rise to concerns about auditor skepticism, as reported by the UK's Audit Inspection Unit, the Dutch AFM, and only yesterday, the Australian Securities and Investments Commission. I am prepared to consider all possible approaches to address the incidence of audit failures, including whether audit firm mandatory term limits would help address the inherent conflict created because the firm is paid by the client. Under existing U.S. rules, all but the smallest audit firms are required to rotate engagements and quality review partners. This requirement dates back to the profession's self-imposed quality control requirements. It was imposed by law as part of Sarbanes-Oxley and the independence reforms. My understanding is that it's now widely accepted generally as a best practice. Partner rotation allows a firm to become aware of a partner's decisions in the audit, but a new partner may well feel the need to live with those decisions and agreements made by his predecessors. He may have little flexibility to reopen them. The partner of a new firm doesn't have that problem. A long-term engagement, and I'm speaking of over decades, can come to resemble an annuity for the firm. Management of the audit client may even populate the company's finance and internal audit departments with the auditor's alumni. To be sure, incentives to please the client exist at various stages in the auditor-client relationship, including in the early years of a relationship when an auditor might be trying to build a long-term relationship by pleasing the client, and inspectors do find failures in early years. Some have offered as the rationale for audit failures in early years that there's an increased risk of audit error inherent in the new engagement because of the auditor's lack of experience with the client. That may happen if firms take on clients they are ill-prepared to audit. That may be a client intake problem. But avoidance of that risk, as opposed to fixing it with better client intake, is not a justification for accepting long tenures if they compromise skepticism. I'm not committed to term limits as the only solution to these inherent challenges. Are there steps other than term limits that would be sufficient to overcome the incentive to avoid being the engagement partner that lost the long-term client? This is a question the PCAOB will, I expect, explore in another concept release, which I hope will be forthcoming soon. The PCAOB is also looking for ways to enhance audit committees' understanding of our inspection process. The U.S. regulatory framework envisions an important role for audit committees in championing audit committee skepticism and independence. In my experience, I've seen both good and bad audit committees, and I have been disappointed to see some signs that audit committees are more focused on fee control than quality control. But I've also observed the more vigilant audit committees and seen how they can enhance credibility of the audit, amply justifying the cost of the auditor's work. Even well-engaged audit committees, though, face challenges in assessing the quality of an audit, including challenges in obtaining from firms a candid assessment of weaknesses identified in PCAOB assessments and inspections. Many audit committee members have reported to us troubling assertions by firms, such as that a particular audit deficiency cited by our inspectors is based on nothing more than incomplete documentation, or that it reflects merely a difference of professional judgment within a range of reasonable judgments. The PCAOB can neither open its inspection files to audit committees nor compel auditors to disclose inspection information to them. But we plan to help audit committees be better informed about our processes and better equipped to engage with their auditors about inspections without settling for responses that distort the significance of our inspection results. Finally, I expect the board to consider a proposal relating to audit transparency in the form of enhanced disclosure about the participants in audits, including disclosure about the partner in charge of the audit, as well as other firms involved in the audit. For many large multinational companies, a significant portion of the audit, as you know, may be conducted abroad, even half or more of the total audit hours. In theory, when a networked firm signs the opinion, the audit is supposed to be seamless and of consistently high quality. In practice, that's often not the case. My first concern is investor and public awareness. I've been surprised to encounter many savvy business people and senior policymakers who are unaware of the fact that an audit report that is signed by a large U.S. firm may be based in large part on the work of affiliated firms, and that such firms are often completely separate legal entities in other countries. Enhanced transparency about how cross-border audits are conducted should help investors and audit committees gain a better understanding of how an audit was conducted and make more informed decisions about how to use the audit report. Let's talk about cooperation for a moment. To best protect investors, inspections of cross-border audits need to be as seamless as the audit is supposed to be. At the PCAOB, we've seen firsthand the benefits of evaluating the various pieces of audits performed by different registered firms in multiple jurisdictions. Our inspectors often see more than the principal auditor or signing firm does. In many cases, principal auditors rely on high-level reports from subsidiary auditors, and they often don't review the work papers of the other auditors. When our inspectors do, many times they found problems in that work. Inspectors have found obvious errors that could have and should have been picked up by the principal auditor if communication between the two auditors had been more robust. For example, inspectors have found unresolved audit issues between affiliates. One inspection team found a situation where the affiliate's audit team pervasively failed to perform audit procedures unbeknownst to the principal auditor until our inspectors conducted their review. Once the problem came to light, the firm arranged for the team to be removed, but it fell to the PCAOB to find the problem. In several cases, inspectors discovered that an affiliate had failed to appropriately audit revenue, even though the affiliate reported to the principal auditor that it had. These findings demonstrate why it's important that we look at the parts of the audit not performed by the principal auditor, whether the principal auditor was in the U.S. or elsewhere. Indeed, they should be of concern to audit regulators in Europe and other countries as well. Some of these examples were in situations where the principal auditor was outside the U.S., but the subsidiary was in the U.S. This leads me to the urgency of regulatory cooperation. I want to thank Commissioner Barnier and his staff for their efforts in breaking the impasse we had faced to conduct inspections of firms registered with the PCAOB but residing in Europe. Based on those efforts, earlier this year we commenced joint inspections with UK authorities. We've also recently begun joint inspections with Swiss authorities, and for several years we've conducted inspections either jointly with audit oversight bodies or in cooperation with the local securities or financial regulator in more than 30 other countries. In joint inspections, we sit side by side with our counterparts, we share audit concerns, support each other's work. We're together examining audits of some of the largest companies in the world. We can well use both regulators' staff resources to examine such large engagements. Under agreements such as those we've recently conducted in the UK or concluded in the UK and Swiss counterparts, we're able to share confidential information relating to the firms we're jointly inspecting. Moreover, this year we plan to inspect the audit of the U.S. operations of a UK-based issuer. If we find problems, we'll bring them to the attention of our colleagues in the UK's Audit Inspection Unit, and we will invite them to join us in any follow-up work, and I expect this model to expand. I believe we are close to reaching similar arrangements with other European authorities. In each case, we're dealing with delays for reviews by data protection authorities. In the U.S., we understand the importance of Europe's data protection regime. It champions goals grounded in historical significance, related to the individual's freedom from tyranny. It's possible, we believe, to conduct joint inspections and still comply with national data protection requirements. And so I urge the European regulators to hasten their consideration of the data protection issues and to avoid further delaying our ability to get to work together with the local authorities here. With the information sharing authority granted to us in the Dodd-Frank Act, the PCAOB will do its part to make this work. Some jurisdictions continue to resist joint inspections, preferring policy of mutual or full reliance. And investor protection is put at risk, not advanced by this approach, we believe. Audits don't stop at borders, neither can effective cross-border audit regulation and inspection. As in the case of audits, in the case of the audit themselves, reliance on high-level summaries of work performed by another regulator presents an unmitigated handoff risk. There may be times when we separately identify audit problems that would be important for a counterpart to know. When that happens, we'll convey the information and support the counterpart's need to analyze the effect on its own investor protections. Leaving oversight, however, of the components of cross-border audits to the inconstancies and inconsistency of separate regulatory processes should not be a goal. As with cross-border audits, cross-border inspections must be seamless to be effective. I applaud and concur with Commissioner Barnier's call in the Green Paper on audit policy that, quote, group auditors should have access to the reports and other documentation of all auditors reviewing sub-entities of that group, and that, quote, group auditors should be involved in and have a clear overview of the complete audit process to be able to support and defend the group audit position. I don't want to leave the discussion, however, of what the PCAOB and all of us as regulators think about cross-border oversight and auditing without a reminder of what we are regulating. We regulate not a market, not an industrial sector, not a product. We regulate a profession. It is a profession that is one of the oldest in our shared commercial history, mere longevity here not being the test. The auditing profession has on the whole served our commercial civilization well. That we are able at all to anatomize the problems of the audit and its relevance for the complexity of the global economy is in no small part attributable to the analytical clarity and independence that the audit profession has devised to our civilization. The auditing firms, the great auditing firms that have evolved, represent an achievement of societal economic development. As regulators, we must not shrink from the truth, from needed change. On the other hand, we are advised to proceed with a full measure of intellectual humility and to heed the advice of Rufus Choate. Thank you all for your attention. It was an honor to be here.
I can't, as I said, Chairman Doty has flown the Atlantic to be with us. And in the program, it does state there will be a short amount of time for questions and answers. So although we are pushing up against time, I will take the time from my part rather than from his part. Yeah. And so questions, please. And the first question is here from Robert Hodgkinson.
Thank you for your speech, and in particular your comments on the need for greater cooperation and the fact that your presence here today shows a willingness to engage. Could I just encourage you to perhaps do even more, because the concept release of last week was certainly met by my institute with great enthusiasm, but perhaps that was tempered by the fact that we, on a very similar topic, have to answer not only your 34 questions, but also the questions of the IAASB, and we're going to have a feedback statement soon from the FRC in the UK on a similar topic, and it's a topic of concern to the European Commission. If we're going to, in learn from the crisis in a way which promotes greater convergence, not a new divergence in the fundamental issue of reporting, could we look for some way that the work could be coordinated and even divided between the various well-resourced groups to make sure that we actually see this as the beginning of a new dawn in how we communicate the results of audit, rather than a new confusion, because we might end up with very many different models around the world which will actually just contribute to the perception that it's difficult to expand an audit business internationally. There are big regulatory barriers there, and actually the auditing profession globally doesn't know how it's going to engage with its stakeholders.
I take your point. I take your point. The question's a good one. It is complex. The concept release process is going to contemplate a substantial period for comments, roundtables, followed by other comments, and ultimately, of course, if it eventuates in a proposing release, the question will be how much or what of the concept release goes in the proposing release. We are, in other words, stages away from a rule. There is a statutory issue here. You know, we're not really at liberty to delegate our standard-setting agenda, but I think it's, from my remarks, you can see we clearly believe that the technicalities have to be right. It has to be something that works for the global firm and the auditors in different parts of the world. And the hope would be that through the comment process and the intelligence we get from our colleagues, that we will come up with a combination of provisions that everyone can see as being a step forward. We're away from that, and we will be listening to a lot of people. And I wanted to make clear that we have already been listening to what you've been doing here, and you can see where it informs the concept release.
Does Hendrik?
Mr. Doty, Hendrik de Schemak from Deloitte. You had been witnessing just a few minutes ago or half an hour ago how the debate on concentration is being done or held. And you have certainly also seen the approach that was taken in respect of concentration by the European Commission. How do you look at that concentration?
Personally, coming at it, as Philip said, as a lawyer, I happen to believe, until I'm convinced otherwise, that market concentration and competitive issues are somewhat different, distinct from audit quality. I do agree with the remarks made earlier that there's no inherent conflict. There's no reason why you will not be able to deal with all of the questions that arise, but we would put, in my view, we would put the emphasis on the quality of the audit. We are I'm focusing on the fact that the global firm is required. We need it as an institution to be able to handle the audit of the great transnational companies that are in fact part of the global economy. I do not think that is a role that is equally delegated. From my remarks on handoffs, you can see what we would fear as being the results of simply mandating or limiting the role of a global audit firm doing a global audit in order to increase the number of tender orders in the process. So there are many complicated questions. There are going to be timing and detail issues that arise under every standard proposal and every change in the audit form or the practice of the audit that any of us make. It will be difficult. It does seem to me that in this context, it is going to be more difficult to achieve audit quality and the enhancement of investor transparency if we're also trying to incorporate competitive standards or increasing competition within that. It's going to be very difficult to do. So my own bias is that the two are just very different, and that because the global firm is, as I said, a great asset to an economic civilization, that we need to audit global transnational companies, that we focus on the audit quality control of the global firm.
One final question. Yes, David York, please.
Thank you. Is this on? Yeah?
Yes.
Okay. David York from ACCA. There are two very large differences between the US audit and the European audit. There are many issues of minor detail. One of them is the fact that in the US, the concept of limitation of liability of auditors is basically no. It's allowed by European legislation, although not in effect. The other fundamental difference is the US integrated audit, as some refer to it, which is the opinion by the auditors on the internal financial controls as well as on the financial statements. Who do you think's got these big issues right, and
There's a
what's
challenge.
going to happen about them?
Well, I think one of the really creditable things the PCAOB did in its early days was to be sure that going back to the integrated audit, it took a hard look at AS2 and came up with AS5. And I had never heard an administrative agency say, you know, we didn't get it quite right, we've got to go back and do it over. PCAOB did do that. I don't look to see the integrated audit abandoned. If there is some sense that with smaller companies, mid-size or other companies, the requirement of attestation from the auditor should be not required, and that waiver of attestation should be available to more companies. Those questions circulate in our country right now. You can make a strong case on both sides, but I don't think we're going to see auditors abandoning the tests of internal controls and the examination of internal controls that we know now coming out of Enron and WorldCom are very important, and that we know frequently are the hardest to establish in some of the small and mid-cap companies. So I don't see the integrated audit being abandoned, notwithstanding the fact that you have changes in the attestation requirement. That would have an effect, but may not affect what auditors do that much. As to liability, it's happily not something that Congress has charged us to fix. But I would say that we are careful. We are careful in our concept releases, in our strategic planning, to think of what we're doing as focused on the audit quality and the audit setting, the audit standard setting issue, with a view not to trying to put a thumb on the scale of liability at this point. We are not trying to influence. We're not. Some people have said the tax code in our country has a bad habit of trying to influence social policy through tax planning. That has been a problem for many legal regimes. We are taking care to be sure that we're not trying to influence liability issues through our standard setting, our inspection process, or our enforcement. Is that?
Okay. Well, I'm going to call this to a close. I will, before I do that, however, I would once again thank you for joining us here in Brussels. Thank you for your contribution to our conference. And I wish you well with your role and your future deliberations. But thank you again.
Thank you.